Don't just short-term speculate. Don't buy and sell all the time. Have a long-term time horizon. That's what they say. But in the end, all of us want to get as much performance as quickly as possible if it's within our risk tolerance. What does long-term investing even mean? Does it mean we have to wait until we are old in order to be wealthy? It depends. It depends on the asset class. For Bitcoin, long-term doesn't actually mean that long of a time horizon. Now, there is a good reason why people say we should invest for the long term. And that's because the long-term holders tend to just make more return than the short-term traders. And that is true even if we ignore all the trading fees. Most of the time, the long-term holders are in profit. So the average cost basis, that's here in orange, tends to be lower than the current price. For the short-term trader, that's not necessarily true. Sometimes we are above, sometimes below. But here is what matters. The long-term holders tend to reduce their exposure when the Bitcoin price is very high. And they tend to add more exposure when the Bitcoin price is very low. They tend to buy low and sell high. And the beauty about the blockchain is that all of that data is transparent. So this here is the long-term holder supply. So it shows how many Bitcoin are held by the long-term holder that have at least not moved their Bitcoin for 155 days. Have a look at this. The Bitcoin price peaked and the number of Bitcoin that was held by the long-term holders was comparatively low. Once the Bitcoin price went down, the number of Bitcoin that was held by the long-term holders went up again. So the long-term holders buy whenever the Bitcoin price declines and they sell whenever the Bitcoin price is up. And so the long-term holder, so the wallet that hasn't moved their Bitcoin for 155 days, tends to be better at calling market bottoms and market tops compared to the very short-term traders. The short-term traders is just the inverse of that chart. So that is this over here. Most exposure to the Bitcoin price happens when Bitcoin is already high. It's another metric to see whether or not the market is currently very heated, right? When a lot of short-term holders are in the market, when a lot of the supply is held by the short-term active trader, it might make sense to take some profit. This is very often how it happens. Bitcoin hits a new all-time high compared to what happened a few years back. This then generates a lot of news attention. So the media talks about it. Maybe the algorithms on YouTube talk more about crypto. Everybody is in profit. And so because of those news, a lot of new people enter the space. Everybody asks, should I buy Bitcoin as well? And this wave of new short-term holders pushes the price higher until that wave is exhausted and there is no new short-term money coming in. That's then when the price peaks. And that's then when the supply held by the short-term holders is at the peak as well. And that in turn is the time where the long-term holders have offloaded the most. So we want to behave like the long-term holders. We do not want to behave like the short-term holders. We don't want to own a lot of crypto when the supply held by the short-term holders is rather high. Now, currently it's comparatively low. This is very counterintuitive because most of the time in the past, when the price was so high, it's close to an all-time high, the short-term holders held more supply. But this time that's not true. The short-term holders are actually not interested in the current price. Attention on crypto is still very, very low. Now, I believe that the main driver of the price development for Bitcoin is not the macroeconomy, it's not currencies, instead it's psychology. It's how much is the market currently in profit or in losses. Now, this is true for the short term, as in if the short-term holder is still in profit, we tend to be still in a bull market. So we see over here is the realized price, so that's the average cost basis of the short-term holder. And as long as the short-term holders are in profit, there isn't too much selling pressure. What really creates the cycles though and the bottoms in a bear market are the long-term holders. The long-term holders stop selling whenever they are in losses. So when the current price is below the realized price of the long-term holder, that's when the selling pressure completely stops. Because if you're a long-term believer in Bitcoin and you think that it will appreciate versus fiat over the long term because it doesn't expand as quickly as fiat supply, then whenever you're currently temporarily in losses, you might just keep on holding. When you're in profit, you might sometimes consider taking that profit and maybe rebalance the portfolio and buy other assets. But when the long-term holder is in losses, that's the perfect time to buy. So this happened after the Mt. Gox and Silk Road collapse. It happened after the ICO boom. It also happened during COVID, and here after FTX. Unfortunately, the long-term holder realized price doesn't get reached too often, right? Just every few years. It's currently increasing quite a bit. It's at 34,500. And if we just go sideways for a bit longer and then see somewhat of a correction, we might have a nice buying opportunity again. I do not expect us to go back to 34K, but I do expect that over time, as the long-term holder realized price goes up, that we will revisit this orange line again. And that's then when your conviction in the asset will be tested. Here's the net unrealized profit and loss of the entire market. So this is now long-term holders plus short-term holders. Sometimes the market as a whole is in losses. That's the time to buy. Sometimes the market as a whole is in massive profit. That's the time to potentially realize some of that profit. We are currently in profit, but we're not in extreme euphoria greed mode. And so there's more potential to further go up. At least the current long-term holders are not necessarily forced to take profit, simply because the rebalancing tends to happen at higher levels. At least that was historically the case. The Bitcoin dominance continues to rise. So Bitcoin becomes a more and more important part of all of crypto, and that's driven by Wall Street. The ETFs are buying Bitcoin, and also the Bitcoin treasury companies like Michael Saylor's MicroStrategy. Altcoin season historically only happened when Bitcoin dominance was at 72%. It still might take quite a few months until we get there if we continue to rise at the current pace. And so the altcoin dominance continues to go down. I expect this again to continue over the next months. And overall, I stay exposed to the market, especially to Bitcoin. Bitcoin is above the 120-day simple moving average. So that's a line here in turquoise. That's historically the best determinant medium term if we are currently in a bull market or in a bear market. Whenever the price is below, we are rather out of the market. Whenever the price is above, we are rather in the market. And currently we are above, and that moving average is at 93,500. So here's why I take the 120-day simple moving average. This is a back test that starts with data in August of 2017. Now I've looked at the trading. If we trade according to the 2-day moving average or the 3-day or the 4-day, and we've got 0.2% trading fees for every long and short. And again, we check that strategy. We go long when we are above, we go short when we are below. Then we can check all of those different moving averages. And I've checked this all the way to the 200-day. And if we then plot that result on a chart, we get this here. So on the x-axis is the duration of the moving average. On the y-axis is the annualized performance. Buying and holding is this black line over here. And if we use a moving average that's at least 30 days in duration, then the trading fees aren't that important anymore. And then we tend to outperform following the trend. We tend to outperform buying and holding. The 120-day simple moving average historically was the best. In general, the strategy tends to be pretty good. Here's the performance over time on a linear scale. So buying and holding is the white line. The back test is the line in turquoise. And here's the performance on a logarithmic scale. So this is very constant outperformance. We get more performance with less potential drawdown. Now this backtest assumes that we do both. We go long whenever the price is above, but we also go short when the price is below. So that's why, for example, over here, when we had the minor collapse after the ICO boom, we actually went up in our portfolio because we shorted Bitcoin during the time. I do believe that this indicator still works very well. I do believe it's the best moving average across all of them. So if you see other people using the 200-day or the 100-day moving average, I think this strategy is superior. And so it's a nice risk mitigation strategy, right? If suddenly we stop rallying, we have a time where we limit our losses. We do not have to go through those massive bear markets where Bitcoin declines by almost 80%. The system we live in is truly fascinating. Some people don't know anything about finance, and of course they get robbed because of inflation. Then there are some people that know a thing or two about investments. They might buy stocks and property and crypto, and they feel like they're getting ahead. And of course they do versus the people that don't invest at all. But in the grand scheme of things, within the system, they're still falling behind. Now, because of the ever-expanding money supply, because the monetary base is increasing over time, the dollar is devaluing, we are forced to invest. And the current narrative is to simply get this into stocks. We might even be forced to buy stocks via retirement plans. The money supply is growing and people think by buying stocks we are getting ahead. This is the S&P 500 over time. This is the money supply over time. Both charts go up, but the S&P 500 relative to the money supply isn't really going up that much. This chart starts in 1959. And if you bought at the exact wrong time, you could have lost 75% of purchasing power. Effectively, by buying stocks, we just protect ourselves against the monetary expansion. But what that means is that we're giving away all of our purchasing power to the big corporations, to the big companies, to then use this productively. And we don't have any way to do something productively, right? We're already buying the stocks. The money is gone. I think in the grand scheme of things, this is bad for the economy because capital concentrates in the hands of a few companies and in the hands of a few mega billionaires. It's really monetary expansion that's driving all of the asset returns. Have a look at the S&P 500 relative to the gold price. So now we've got two assets that are impacted by monetary expansion to the same degree. We did not see any outperformance of stocks versus gold over the course of 90 years. We can also take this reference point over here. Again, pretty much no return over the course of almost 100 years. Here is gold relative to the money supply. The chart starts in 1959. And again, can we really say that gold long-term outperforms or underperforms? It's just going in line with monetary expansion. And so it's no coincidence why Bitcoin got all of that adoption, right? Bitcoin was started during the global financial crisis. And during that time, the monetary base expanded extremely quickly in order to bail out the banks. Now, why did the banks have to get bailed out? It's because of fractional reserves. So the bank doesn't have to hold all the money that it claims to have. When you've got $1,000 in your bank account, the bank might only hold $100. They're simply speculating on you not withdrawing all $1,000 at once. If the majority of customers decides to do so, we've got a bank run and the bank is going bust. Just think about what kind of a scam that is, right? Imagine you were to buy a car, but you don't have enough space in your garage. So you tell the dealer, just keep the car at your place. And whenever I want to drive the car, let's say it's some kind of luxury car, a sports car that you only drive on the weekends. Whenever I want to drive the car, I just come to you again and I pick it up. So that's the deal that you've got with the car dealer. And then that car dealer sells the same car to 9 other people. And the only thing that the dealer is speculating on is that those 10 people will never want to drive the car at the same time. You don't really own the car. You only feel like you're owning the car. But the exact same car is owned by 9 other people. And that's the exact same thing that's happening with the banking system. You've got all of those dollars on your bank account, but the bank doesn't own those dollars. There is fractional reserve. It is legalized fraud, and it's simply developed historically because historically there were banks that had claims on gold and nobody wanted to withdraw their gold out of practicality all at once. So in the end, the banks figured out we don't have to hold all the gold. We can just issue the claims. As long as people don't claim their gold all at once, everything is fine. That's now happening with the dollar. With stock investments is that we give all our purchasing power to the big corporations that then use this productively just to escape this hidden tax, the debasement of the money. The problem with Bitcoin, though, is that we still have volatility. Bitcoin got created over here in January of 2019. So again, this is the S&P 500 relative to US money supply. We've got our .com bubble, the subsequent bust, then a slight recovery, and then the global financial crisis where the banks got bailed out. The very first block that got mined in January 2009, it had a message referring to a Reuters article that discussed the second bailout by Chancellor Merkel at the time. So that was in Germany. But since that global financial crisis, we never really saw a real correction in the markets. We did have COVID, but COVID was comparatively small. So again, the S&P 500 relative to US money supply, here we've got COVID, but we had had a very quick recovery since then. So during the entire lifetime of Bitcoin's history, we never really had anything major happening to the system. Now, the reason why this is a problem is because we do not know what's going to happen with Bitcoin during a major correction, especially since now more and more Bitcoin is moving towards Wall Street, towards people that just see Bitcoin as another risk on play. At the top, again, we've got the S&P 500. In the middle, we've got the Bitcoin price. And at the bottom, we've got the correlation coefficient of the S&P 500 to the Bitcoin price. So the vast majority of the time, the 1 year correlation coefficient is somewhere around 0.6, 0.7. It tends to get closer and closer to 1. So that means that the two assets tend to move in the same direction at the same time. And so if we see now a sudden sharp decline in the stock market, we are likely going to see another sharp decline in Bitcoin as well. Now, don't get me wrong. I am a fan of Bitcoin. I am a fan of crypto. But that doesn't mean that everything is always smooth sailing. We have to also play devil's advocate. We also have to look at the things that aren't potentially that great. We've already seen how gold is, to a degree, already protecting against monetary expansion. Because even though there are decades where it performs very poorly, over the very, very long term, it tends to just appreciate with the monetary expansion. So gold is already a hedge. And so to a degree, Bitcoin is competing with gold. Even though the volatility is much higher, there are some question marks. So this here is now Bitcoin relative to gold. And in the last 4 years, we really did not see that much outperformance. So this is when Bitcoin hit 63K. This is when Bitcoin hit 100K. And yes, maybe from peak to peak, there was some outperformance. So this is now 8%, but it's not really worth it given the additional volatility that we get. And so because of that, because Bitcoin's market cap is already so high, most people just look for the alternatives in the altcoin market, right? Are there maybe altcoins that are small enough that still have potential upside where you can make the multiple X returns that we saw in the past in Bitcoin? Because in the past, Bitcoin obviously outperformed gold. And while it might still outperform in the future, the relative growth is definitely declining. But then there's the problem with the altcoins. This is now the altcoin market cap. So it's a measure called others. That's the market cap of the altcoins that are not in the top 10 relative to the market cap of Bitcoin. And so if we go more risk on in order to get higher performance, this does not come without risk. So this is an underperformance of 77% since January of 2022. Have a look at those smaller altcoins that might still have some outperformance. This is the performance in the last year. There are 1, 2, 3, 4, 5 winners, and all the rest went down. Altcoins are great when a lot of new people enter the space. When people that don't know much about crypto, they want to get the next 10x returns and they buy everything left and right. That's the time to be in altcoins. But we are not there right now. This overview is living proof. And when we look at the number of searches for Bitcoin here in blue or for crypto in red, it's very, very low. So there aren't new people coming into the space. This is not a retail-driven market right now. Just have a look at the best performers in the last 24 hours on the Solana chain. So this is a chain that's very much retail-driven. It's all micro caps. The liquidity in those tokens is less than $100,000 for most of them. And that's after the rally. So before they rallied like this, there were only, say, 10K worth of liquidity. It was pretty much a non-existent coin. And so trying to make money with altcoins in a market like this, I believe, is a mistake. The underperformance is just too constant. And so I just flip the script around. So instead of trying to find the needle in the haystack, the one altcoin that might perform, I just bet on most altcoins doing worse, as they have done in the past. I've also made dedicated tutorial videos on this, how to win in bear markets by shorting altcoins, and why we might not be in a bear market because Bitcoin is close to the all-time highs, the altcoins still continue to do worse. And so we can hedge ourselves against the macro, right? We can bet on the altcoins doing worse than Bitcoin, we don't necessarily have to bet on an altcoin going down in US dollars. We can just bet on it going down versus Bitcoin or versus Ethereum. And of course, we don't want to do this with assets where there's a lot of attention. We don't want to do this with SPX 6900 or virtual protocol. We want to do this with tokens nobody is looking at. All those constant underperformers. And so I'm sharing the trades that I do in premium. The link is down below. It's thebitcointrader.com. This is also where you find those tutorial videos. Here's a message how I closed my WorldCoin relative to Ethereum short. And in the end, this made quite a bit of money if we apply smart risk management and smart leverage. Just have a look at our members, how they're also making money with the exact same approach. So it doesn't really take that much rocket science in the end. We just have to look at the tokens that get neglected, that have increasing token supply, and that tend to just underperform long term. Essentially what we're doing is we are flipping this screen around. So every red bubble becomes green, every green bubble becomes red. And this works phenomenally in a market where there is no retail interest, because Wall Street doesn't buy those micro caps. This is all just retail demand, and retail demand is low and will likely continue to stay low until we see massive new rallies in Bitcoin again. When Bitcoin is at 150 or 200K, things might turn around. But in the current market, I take the occasional 50, 60, 100% every now and then, and I'm happy with that. And so if you've been losing with altcoins over the last few months and you're looking for a new strategy, then feel free to check it out. It's down below. It's thebitcointrader.com. It's currently $125 per month. The price is lower compared to the bull market. In the bull market, I did increase the price. If you're now locking in the 125, that's your price. So even in the next bull market, when I will increase the price again, you will continue just paying that rate. Whoever signs up for the low rate will keep the low rate. Now, a link to premium should directly pop up over here on the screen. Feel free to just click it. It will bring you directly to the sign up page. If it's the very first time over here, feel free to subscribe as well. I publish this regularly. A like would be very much appreciated as well. See you next time on YouTube, or see you in premium. Cheers.